Every new investor gets excited when they finally hit the $1,000 per month dividend income. This milestone will surely bring you closer to retirement as interest accelerates in a compounding effect. Of course, by hitting that mark, you will be able to notice some good changes in your income. As your income from your investment grows, the motivation to work grows along with it, as the chances to see promising results become reality. You are now just a few steps away from your dream lifestyle and retirement. If you want to know how much you really need to reach this point, stay tuned as we're going to discuss various scenarios that would show how much is needed to receive $1,000, as well as be able to choose the right option for you. Hi! Welcome to Grayson Finance. In today's video, I'm going to be talking about how much you need to invest for you to receive $1,000 a month in dividends. First things first, in order to reach the mark of finally earning that $1,000, you need to choose a desired dividend yield. Contrary to what you may want to choose, the dividend yield that you should choose may not necessarily be the highest, but it should be the most compatible with your situation, partnered with a decent amount of growth income and stability. You might be wondering why a lot of people still settle for stocks that only yield a 2 to 5% dividend. While there may be stocks out there that yield up to 12% or more, the higher the dividend yield, the greater risk for you. A lot of times, stocks that only have low dividend yields are accompanied by very minimal risk for the investors. The high dividend yield on stocks is risky because of situations such as a price decline or dividends being at risk. This usually happens with individual stocks, which is why it's extremely risky to choose it. The safer route to go is choosing a yield going on from 0.5 to 5%. When investors purchase assets with unreasonably high dividend yields, two problems may arise in this situation. First, a high yield can mean that the company has slow growth prospects, demanding the market for a high yield. This particular situation happens because there will be little in the way of stock appreciation. For instance, a tobacco company called Altria has had the same dividend yield since 2014. This company's stock has been rising and falling, and due to that, its dividend yield is at 8%. Even with that 8%, however, investors would only get very little growth in the share price. The second problem that may arise with a high-yield dividend is that the dividend isn't safe. This problem is heavier than the first one, as it now concerns the company reducing or suspending dividends in the future because of very poor business performance. It's important to always do research in order to not end up purchasing stocks from these kinds of companies. If you are the type of investor that prefers a hands-off approach, Schwab's SCHD Dividend ETF may be the most suitable for you, as it's very popular and well-liked among investors. This fund's return is similar to that of the Dow Jones US Dividend 100 Index, which holds big companies like Home Depot and a lot more. Investing in this will make you get a 3% yield with stability, while having a reasonable amount of growth to make sure that your investments only go up in value as time goes by. In order to achieve an average of $1,000 per month or $1,200 per year, you will need to invest $400,000 worth of the stock. This is actually a very good option to choose because it holds blue chip companies that are very most likely to pay continuously, as well as an increase in dividend over time. On the other hand, if you are the type of person who wants to make the most out of a long period of time, the best option that you can consider is a VUG, a Vanguard's Growth ETF. This option is best for investors that don't necessarily take dividends importantly, but instead are more concerned about receiving higher overall returns. This type of fund tracks the CRSP, Large Cap Growth Index, which, on average, grows very quickly. The speedy growth is because of the large established companies as the largest holdings, such as Apple, Microsoft, as well as Alphabet. However, the dividend on this one is only 0.44%, making you need $2,750,000 in order to earn a $1,000 dividend every month. You might be wondering why that's very little dividend with your very expensive capital. Well, you need to consider that the growth alone outpaces what you are likely to receive with both dividends, as well as growth with the dividend fund. One of the best options you can choose with a nice mixture of growth and dividends is a purchasing fund that tracks the S&P 500. If you do this, you will be able to receive an average amount of income as well as an average amount of growth. If you are the type of investor who doesn't like to think about investing strategies and wants to have a somewhat balanced portfolio, then this is the best option that you can choose. When you purchase a fund such as a VOO or the Vanguard S&P 500 ETF, this will make you gain access to various companies of all kinds. You'll be able to own a portion of big companies such as Apple, Microsoft, and even Google. In terms of dividend yield, you will need to expect only an average one at a 1.31% dividend. If your goal is to receive $1,000 every month, you will need to invest the amount of $920,000. While this is still a very large amount, it's a lot smaller than a more aggressive fund. If you want a stock that would enable you to receive high dividends as well as more diversification than a single stock, consider purchasing a sector-specific fund. Sector-specific funds are entirely dedicated to a certain sector, such as real estate, industrials, financials, and more. If you research the different kinds of options this type of fund offers, you may be able to find some that pay a higher dividend than others. Of course, there's a catch on sectors that provide a high yield. Before investing, you need to know and understand why the risks are higher and then be able to assess that risk. For instance, Vanguard Energy ETF with additional risk associated with it yields a high rate of 3.5%. In order to get that $1,000 every month, you will need to invest $350,000. The option you probably don't want to consider yet is to purchase an individual dividend stock because of its risk and high unpredictability. However, with this choice, you might achieve higher yield and growth. You've heard of the tobacco company Altria, and in order to receive $1,000 every month in dividends, you only need to invest $150,000 into companies such as this. In relation, you need to be able to remember that the future of the stock price is less predictable than opting to buy something with more diversification. Chasing a high yield blindly would only make you bound to lose your money. Once the pros and cons are already laid out in front of you, you might be wondering which path to take now. Smart investors strategize mainly focusing on growth in the early part of their investment careers. Being a new investor, your primary concern should be achieving higher growth. If you are still young, you shouldn't take dividend income seriously, yet unless you plan on retiring early. Young investors that focus only on growth are more likely to achieve better annual returns than those whose main focus is dividend incomes. Having high or even just slightly better annual returns can make a huge difference over time. When you're getting closer to retirement, on the other hand, you can turn your focus into dividends if you're planning on living off those payments. At an older age, it's good to be more focused on income safety as well as capital preservation. Of course, a dividend investment strategy provides more safety and stability than a growth strategy. Before deciding what path to choose between growth and dividend, the first thing you need to consider is how far you are in retiring. Thanks so much for watching! I hope you liked this video. Make sure to press like, subscribe, and hit that notification bell to keep you updated on new exciting videos.